You can be a stock market genius. A book by Joel Greenblatt, presented by Ritik and Jay. Now, about the book teaches a list of corporate events that can result in big profits for you, like spin-off, mergers, restructuring, rights offering, bankruptcy. But drawbacks of investing in special corporate situations, two. The first is it will take some work. The good news is that you will be well paid. The other drawback may or may not be applied to you, although some of these extraordinary corporate events play out over period of years, other transpire over period of months. Let's go to next slide. A diversified portfolio. The strategy of putting all your eggs in one basket and watching the basket is less risky than you might think. Owning a widely diversified portfolio of stocks should enable you more or less to mirror the performance of the popular market averages. Unsystematic risk is avoided by diversified portfolio. Unsystematic risk means which is not in our hands, like rare earth crisis. Now let's go to next slide. Risk versus reward. The more risk you assume in your portfolio, the more reward you receive in the form of higher returns. The less risk assumed, the lower the return. In short, you can't get something for nothing. In a perfectly efficient world, this relationship between risk and reward should hold true. Since you will be looking for pockets of opportunity where there are inefficiently priced investments, example, stocks or investment situations so far of the beaten path that analysts and investors have not priced them correctly. The immutable in relationship between risk and supply should not apply. A stock that moves up significantly over the course of a year is labeled riskier than a stock that moves slightly down during the same period. A stock that has fallen from 30 to 10 is considered riskier than a stock that has fallen from 12 to 10 in the same period, although both stocks can now be purchased for $10. The stock which has fallen the farthest and one that is now priced at the biggest discount to its recent high price is still considered the riskier of the two. It might be, but it could be that most of the stock's downside risk have been eliminated by the huge price drop. The truth is that you can't really tell much or anything just from measuring a stock price past movement. One way to create an attractive risk reward situation is to limit downside risk severely by investing in situations that have a large margin of safety. Let's go to next slide. Spin-off. What do you mean by spin-off? Spin-off can take many forms, but the end result is usually the same. A corporation takes a subsidiary, division, or part of its business and separates it from the parent company by creating a new independent freestanding company. In most cases, shares of new spin-off company are distributed or sold to the parent company's existing shareholders. One study completed at Penn State covering a 25-year-old period ending in 1988 found that stocks of spin-off companies outperformed the industry peers and Standard and Poor 500 by about 10% per year in the first 3 years of independence. Now, let's go to next slide. Why do companies pursue spin-off transaction in the first place? Unrelated business may be separated. Why a spin-off transaction? So that a separate business can be better appreciated by the market. For example, a conglomerate in the steel and insurance business can spin off one of the business and create an investment attractive to people who want to invest either in insurance or steel, but not both. One example would be Marriott and Host International. Marriott was charging management fees for managing hotel owned by others. Marriott was stuck with a lot of unsellable hotels and an overbuilt market and burdened with billions of debt it had taken on to build a hotel. Marriott wanted to leave all of the unsellable hotel properties and low growth concession business burdened with essentially all the company's debt in one company, which is Host Marriott, and spin off the highly desirable management service business, more or less debt free, into a company to be called Marriott International. If the analyst quoted in the press report turned out to be correct, Host stock could trade at $3 to $5 per share, but the new company would also have somewhere between $20 to $25 per share in debt. For purpose of our example, let's assume the equity in Host would have a market value of $5 per share, and debt per Host share could be $25. This would make the approximate value of all asset in Host $30. Thus, a 15% move up in value of Host asset would practically double the stock. That is 15% into $30. That is $4.5. Now, Sometimes the company's motivation for a spin-off is to desire a separate out or a bad business so that an unfettered good business can show through to investors. Like one example in the book was home shopping. HSN network is both a retail oriented and a broadcast company. Broadcast companies are typically valued based on cash flow, while retail companies are typically valued on earnings per share basis. The categorization of HSN as either the broadcast concern or a retail-oriented company results in the application of a single valuation methodology, when a combination of two valuation methods would be more appropriate. Valuation of HSN as a retail-oriented business is severely discounted by the impact of the substantial depreciation and amortization costs associated with the broadcast assets of the station. A quick look at Silver King's income statement highlighted this point very clearly. Silver King's operating margins were slightly over $4 million for the most recent years. Its cash flow, however, totaled over $26 million, $4 million in operating earnings, plus roughly $22 million of depreciation and amortization. Since broadcast equipment doesn't have to replace that often, capital spending on new plant and equipment was only about $3 million. This meant that before accounting for interest and taxes, Silver King was actually earning nearly $23 million in cash from its operation. Operating earnings of $4 million plus depreciation and amortization of $22 million, less $3 million in capital spending. The broadcast properties contributed only $4 million to operating earning, but as we have already seen, they added over $26 million to home shopping operating cash flow. Since HSN had over 88 million shares outstanding, $4 million amounted to only about 4.5% share of operating earning loss from spinning of the entire broadcast demand. But wait, that's not the whole story. Home shopping was going to shift more than $140 million of debt over to Silver King as a part of the spin-off process at an interest rate of 9%. This meant that HSN was going to be relieved of over $12.6 million in annual interest costs. That is, the bottom line was that as far as much of Wall Street was concerned, the home shopping network would earn more without the broadcast properties than within. Reported earnings before taxes would be approximately $8.6 million higher after the spin-off. 12 now Next example would be the tax consideration can also influence a decision to pursue a spin-off instead of an outright sale. For example, if a business with a low tax basis is to be divested, a spin-off may be the most lucrative way to achieve value for the shareholders. Now let's go to the next slide. What to look for in spin-off? Insider participants is one of the key areas to look for when picking and choosing between spin-off. For me, the most important area are the managers of the new incentives rise along the same lines as the shareholders. Will they receive a large part of their potential compensation in stock, restricted stock option? Is there a plan for them to acquire more? Now let's move to the next slide. Partial spin-off. Partial spin-off transaction, a company decides to spin off or sell only a portion of one of its division instead of spinning off 100% ownership in a division to its shareholders. Only a portion of the division stock is distributed to the parent company shareholders or sold to the general company. The parent company retains the remainder of the division stocks. Now let's take example. For example, if XYZ Corporation distributes 20% in its widget division to its shareholders, 20% of widgets outstanding share will trade publicly, while 80% will still be owned by XYZ. Your second opportunities comes here where you break out your first grid match cycle. Once the stock of the partial spin-off is publicly trading, the market has effectively valued the spin-off. So for example, if the widget division of XYZ Corporation has 10 million shares outstanding and 2 million are sold to the public for $20 per share, that means XYZ still owns 8 million shares of widget. The value of those shares works out to be $160 million by a $20 share price. Then now comes the second opportunity. By doing this simple math, you know two things. Of course, you know the value of XYZ 80% stake in widget, which is $160 million. However, you also know the value, the market price on all the rest of XYZ business. That value is equal to the market value of XYZ less 160 million. Here's how it works. If XYZ has a market value of $500 million and its 80% widget stake is valued by the market at 160 million, that implies a net value of $340 million for rest of the XYZ business. Now, let's take another example of Sears. In September 1992, Sears announced its intention to sell a 20% stake in two of its subsidiaries to public. Sears management had been under pressure to improve the performance of its stock price for years. It was Sears' contention that the value of two subsidiaries, Dean Wilter, including Discover and Allstate Insurance, was not adequately reflected in share stock price. Share stock price and subtracting the market value of its remaining stakes in Singh Water and asset, a value for the rest of Sears asset, primarily department store, could be calculated. A 20% stake in Dear Wilter was sold by Sears in February 1993. Sears' stated intention was to spin off by a distribution directly to Sears holders, its remaining 80% interest in Dean Wilter in the next several months. In the beginning of June, Sears sold a 20% stake in Allstate for $27 a share by beginning of July, just before Sears' distribution of its remaining stake in Dean Wilter. And this is how things stood. Dean Wilter's stock was trading at approximately $37 per share. Alsted stock was trading around $29 per share, and Sears stock stood at around $54. The math worked like this. Sears had announced that it would distribute its remaining 80% stake in Dean Wilter. According to the announcement, this meant that for every 100 shares of Sears, a distribution of 40 shares of Dean Winter would be made. Sears was distributing 136 million shares of Dinvita and approximately 340 million shares outstanding. So the distribution ratio was zero point 0.4. Therefore, in mid-July, each Sears shareholder would receive shares in Dinvita worth approximately zero point 0.4, the announced distribution ratio, multiplied by $37, the trading price of Dinvita stock, or approximately $15 worth of Dinvita stock for each share of Sears owned. Since Sears were trading at $54, therefore the distribution this translated to a net price of $39 for the remainder of Sears. Primarily, it was Sears remaining 80% stake in Ansted, its foreign and domestic department store business, and various real estate business. However, we also knew something else. The market value of Sears' 80% stake in Ansted. Sears owned approximately 340 million shares of Alsted. Sears itself also happened to have approximately 340 million shares outstanding. This meant that if you owned a share of Sears, you also indirectly owned a share of Alsted. With Alsted at about $29 for about $10 per share, you were getting the foreign and domestic Sears department store business. The that $54 shares include one share of Alsted, which is at $28. So that leaves us $26. Then you get zero point 0.4 shares of Window, which is $15. This leaves us $10. About $2 or $3, that is Sears Mexico and Sears Canada. That leaves us about $8. Coldwell Banker is worth $2 or $3 a share. So that leaves us $5 a share, a market cap of about 1.5 billion for the retailer with $27 billion in sales. The new management seems very focused. It's almost debt-free retailer with huge real estate opportunities. A quick check revealed that Sears was shipped with $27 billion in sales and 340 million shares outstanding. Sears had $79 per share in sales. If those sales could be purchased for $5 a share, then that worked out a purchase price of just over 6% of sales. Thank you. Next slide will be next slide. Let's go to next slide. Why do companies pursue partial spin-off transaction in the first place? Sometimes a corporation may need to raise capital. Selling off a portion of a division while still retaining management control may be an attractive option. At one time, the motivation for pursuing a partial spin-off is to highlight a particular division true value to the marketplace. Its value may be masked when buried among the parent company's other business. A separate stock price for that division enables investors to value their division independently. Also allows for incentive compensation for divisions managers to be based directly on divisional performance. Now, Ritik will take over from you.
Try and understand risk arbitrage. Just to quote the author of the book, it says, too many things have to go right too often. Let's try to understand what is the meaning of risk arbitrage. Risk or merger arbitrage is the business of buying stock in a company that is subject to announced merger or takeover. That means it is a target which is being acquired by a company. Let's try to understand what it means, like the risk arbitrage timeline. If we see, uh, if we see in this example, there is prior announcement. The stock price of B is $25. A has announced to acquire B at $40 per share. After announcement, if we see the stock price of B is $38, which is less than the proposed acquired price of $40. See, if the acquisition goes through successfully, then the net gain made by the trader is about $2. However, there are two major risks which factors in this kind of a situation. One, what if the deal doesn't go through? The arbitrage trade can go sideways if it doesn't go through. Why it won't go through? Two reasons would be the losses. The target company has incurred losses. There's also been a regulatory reasons, such as the because of the competition, the antitrust laws. There is the acquisition is not able to go through. The other one would be the timing risk. If the time taken for the acquisition is too long, such as 2 to 3 years, then it would not make sense because it would earn a very low significant, like it would not make a significant difference to our investment. So if we see with an example this risk, we can find, like if we go back to the previous example, we see what if once we buy that stock of B at $38 post announcement and the deal doesn't go through, then two things might happen. One, we are not gaining the $2 which we projected to gain in this transaction. And the other, what if the B prices drops to from 38 to say like 34 or 35? Then we would net be like a $4 loss. So that's why this the author significantly discourages to invest in such kind of risk arbitrage. Now let's try to understand what does it mean by merger securities. We see merger securities are nothing but the mode of payment for an acquisition which is not done through cash or stock. Usually, acquirer buys target by either giving cash or the stock in the acquiring company. And then why would such merger securities, which are neither cash or stock, be lucrative to invest? First, we see the acquiring company would issue them because they have exhausted their ability to raise cash or issue equity. They would not have sufficient cash or didn't want to raise any additional equity in order to give to the target company. The other reasons could be this is the reason why they are issuing merger securities. Also, if we see, if once the merger securities are issued, the individual shareholders have no interest in holding such kind of convertible debts or other structured products in order to be held in their investment portfolio because they want to invest in equity of that company and don't want to be a debt holder in that company. So because of that, the individual shareholders would try to sell as quickly as possible as they get their hands on that securities. The other would be institutional investors. As the equity would contain, like the shareholder breakup would be like individual as well as institutional. These institutional shareholders would also not be able to hold these kind of merger securities as their mandate sometimes would not allow. Like most of the times, the mandate doesn't allow like an equity fund to hold like debt securities. So because of that, as soon as they get those kind of securities, they would immediately sell in the market. This results in excessive selling of such convertible debts, warrants, etc. in the markets. And then because this leads to depressed pricing, and also it makes a good investment opportunity for others who are actually looking to invest in such securities. So this is reason why merger securities are something which should be looked for when if gotten a chance. Now let's try to understand what is bankruptcy. So there are few reasons for bankruptcy. One could be a lousy business. That means the business in itself was not sustainable. The business didn't have any good qualities to survive in for the long term. The other would be mismanagement. Management was not capable to handle such a business. Otherwise, they took some wrong decisions in terms of capital allocation. They were not investing in revenue generating or like net increasing the shareholders' value in the company. This would result in the mismanagement and also lead to bankruptcy. The other would be over expansion. Sometimes company take excessive debt in order to over expand, in order to expand in the industry. This excessive debt, if it is a cyclical business and the cycle goes out of favor, then then the company would not be able to service debt, and due to which the company would in turn would have to file for bankruptcy. The other one would be product liability. In some cases, such as in like pharmaceutical companies, they issue drugs, they manufacture drugs, and sometimes the drugs might have some kind of side effect which could in turn be harmful for the ones who are consuming it. So because of that, there might be severe lawsuits filed by the uh, filed by the individual in against the company. This could lead to a significant the settlement amount could be such huge that it could bankrupt the entire company. The other one would be like insurance companies. The product in itself is designed to be given out as a settlement amount. So in case if bad insurance policies are underwritten by the company, eventually they might be bankrupt, servicing those settlements. So the author suggests investing in such former bankrupt companies who are now like they are coming out of bankruptcy. And why they want to do that? Such investors are called vulture investors. And why these vulture investors invest in such kind of coming out of bankrupt companies? The first, the new stock which is issued by this former bankrupt company, it usually goes to a bank or debt holders as they have the first right on the company. So these new stock of these companies go to them. But since they just want to get their money back and don't want to be a long-term holder of such kind of stock, if they get a good price for that security, they usually sell it immediately in the market. So this results in like excessive selling again and leads to depressed prices. So these vulture investors, they come and they buy such securities at the cheap prices, and then and if the management when it does well, they might will make more money in that kind of situation, and the returns could be tremendous in that scenario. However, we should be aware and not just buy every former bankrupt company, as the reason they could be bankrupt is the management still hasn't learned from its mistakes and still committing the same mistakes. And that's why to invest in such a company, we should always look for good business attributes, such as the market should be quite niche and there's no other player in the market, and the management now has a clear focus because they did uh, some misallocation in the past, which now they are cleared in the bankruptcy process, and now they have a clear vision and focus in order to grow in that small market niche. The other is the brand name. If the brand name is very big, like the American Express scenario, which is discussed in the book, the brand is so big that even if they have had credit losses in the past, it's not supposed to, because people will still go and prefer that brand. So even if it is coming back, it could make a good decision in this situation. The other is the industry position. If the industry is highly competitive and there is no scope for error from other companies, as because it is competitive, the one has to get market share from those players, which would be very tough. So in that situation, we would have to be worryful about that. If there's no other competition in the industry, and the former bankrupt company was in the pole position, then they could make a good sense in investing in such a company. The author also describes about some of the selling tips. It says like if there is substantial increase in the stock price or the business fundamentals in itself has changed, then you should always sell, because as he discussed in the book, like selling is more harder than buying, as we can buy when the prices are depressed, we can buy when there is some kind of announcement of a corporate action, etc. But while in case of selling, we have to be very mindful, such as if we invested in a corporate like if we invested in a security because of some corporate action event, we need to sell it as soon as this corporate event attributes are widely known to the public, as the investment thesis in itself was because we invested because of the corporate action event. So that's why we should sell. Also, the quality and the nature of the business also determines how long the holding period of that security is. If the holding period is if the quality of the business is good, then the holding period can be long and will still make money. Now, let's talk about corporate restructuring. Corporate restructuring means we are selling or closing one of the biggest divisions of the company. And when we say big, we say in terms of the company, like the proportion, what kind of revenue is coming from that division. So if we look like why we should look at such kind of restructuring events, and what should we learn from that? So if we see like this kind of opportunities usually come from a business's closing its divisions, like the one of the biggest revenue drivers of the division. So it could be because they want to, stop their losses. They have incurred significant losses in the past in that division, and in order to reduce their losses, they are just closing or selling that division entirely. The other could be they want to pay off debt. They want to reduce the balance sheet. So they could just sell one division which is not performing that well and then pay off the debt and make the balance sheet a bit light. The other would be to start new lines. The business would have decided, like, there is much more growth in different line of business, which is more than that of the existing line. So they might, close or sell the division and then just put the entire focus on this new line of business in order to grow that business and gain market share there. So if we see, like, if we try to extrapolate that scenarios, we can see, like, if a company is doing a corporate restructuring in order to get rid of the losers, then it can increase the market price of the company. Because earlier, if the company is earning like $2 per share, and there's $1 of losses which is coming, then if we take out the loser from the company could earn $3 per share, as the $1 loss which was incurring, taking the earnings to $2, has been now entirely shelved out. So that's why if we see, the company's earnings will grow, and at the same time the company's stock price will skyrocket. So that's how we can see, like, as the losers are gotten rid of, the market price increases. The other would be like management are now because of the loser segment, as well as the segment which is not doing that well also, even if it is growing. But so management, if we get rid of that division, then the management can put more focus on the line of business which is actually going to be of significant growth. So this would allow management some kind of room in order to focus on that. The other would be investors would be willing to pay a significant amount for such kind of business, as the company will now be investors might pay a little bit of more premium to such kind of specialized businesses. So there are two ways to invest in such kind of companies. One would be to after the announcement has been made, as sometimes there is significant lag between when the announcement of made, as people tend to take time in order to research and find if there is any significant like if there is a return to be made in such kind of event. And sometimes some smaller companies doing such kind of restructuring activities, there is limited analyst coverage. So that's why the lag for the lag for such kind of a change in the restructuring process could be seen much later. So that's why this gives a significant time for investors to look and research these opportunities and maybe then take a position and make money. Also, sometimes what can happen is you identify as company which you seem like it is now almost ready for a restructuring event. Like the management has been saying in the conference calls or press releases, like they want to focus on a new line of business, and they are not doing that well in the current existing line of business. So this could hint like a restructuring event is going to take place in the near future. So that then it could be a good time to buy such company. But be mindful, like we never know like when that decision of actual restructuring is going to take place. As if it takes place significantly later, like in this example of in the book, where he tried to invest in a toy company which was earlier a distributor, then became a manufacturer of toys, and they wanted to sell the distribution business. So it took like the author took the position in the author took a position in the distributor like a year back, and the stock price didn't move. So after 1.5 or two, approximately 2 years later, the company announced the restructuring. So such kind of situations could also happen. Like till 2 years, they will make practically no return on this kind of investment. So that's why it's kind of hard to invest before the announcement is made. But if you make, then there is a big return you can generate as well. Now, the further current affairs will be discussed by my partner, Jai.
will say go with current affairs. So last month we discussed the current affairs. The related was tariff. Now in 1 month the update has come like government tariff will lower the CNG PNG prices. Transportation charges will be 54 rupees per million British thermal units for distances up to 300 kilometers, and rupees 102.86 per MMBU beyond 300 kilometers. However, all CNG and domestic PNG consumers will be charged the zone 1 rate at 54 rupees per MMBTU, irrespective of distance. The revised tariff will reduce CGD transportation cost by around 1,000 crores annually, translating into a lower delivered prices for consumers. CNG by 1.25 rupees to 2.50 per kg, and domestic PNG by 0.90 rupees to 1.80 per standard cubic meter. In April November of FY26, about 46,239 million standard cubic meter of natural gas was consumed, 6.7% lower on year. FY25 consumption rose 6% to 71,314 SSCM on strong power sector demand. China plus one. How did China become what it is today? Unlimited land was given to farmers at that prices. Government even funded companies to bring top machineries from Europe and America. They created extensive manufacturing clusters, providing extensive tax exemption. Battery recycling gathers space, with companies starting to recover critical minerals such as lithium, cobalt, and rare earth elements from secondary resources. This approach will not only reduce import dependence but also strengthen supply chain and promote sustainability by treating waste as a valuable resources. RBI, home buying become more affordable now? Among the three key parameters of weighted average prices, income level and mortgage rates influencing affordability, incomes have risen faster than prices. This, coupled with falling interest rates, has boosted affordability. Ahmedabad is the most affordable among the top 8 cities, with an EMI to income ratio of 18%, followed by both Pune and Kolkata at 22%. The ratio for Mumbai eased to 47% in 2025, meaning affordability has improved since COVID. Affordability is likely to improve next year, as well as with higher income and cheaper loans, but real impact depends on market offering more budget-friendly housing option. Now let's move to next slide. IPOs. 344 IPOs has been listed in India over the last 12 months. Only 50% of them are trading above offer price. October alone has 53 IPOs. Volume accelerated sharply from July. November saw second highest capital raise despite fewer listings. July 43 listing, August 45 listings, September 52 listing, October 53 listings, and November 22 listings. Almost 150 IPOs have given a return from offer of between 0% to 100%, while around 200 IPOs have given a return from offer between 0% to 500%. 50 have given return from 200 to 500%. 257 SMEs have raised around 10,964 crore in 2025, a record high. SME platforms were designed to help smaller firms raise capital without meeting the stringent norms of a main board listing. SME IPO has attracted major investors looking for sharp listing gains, but the risk far outweigh the potential rewards. Retail investors should avoid the SME IPO market, at least for now, as the margin of error remains thin. Currency depreciation. A weaker rupee should help boost exports and disincentivize imports, and thereby keep the CAD at sustainable level. Exchange rates are typically meant to be an economic shock absorber to external pressures or changing economic fundamentals, so that other variables in the economy don't have to undergo disruptive changes. Tariffs imposed by the United States on India are 34%. The longer we wait for a trade deal, the greater should be the onus on the rupee to serve as a partial offset to competitiveness pressure. The NEER is a summary index capturing movements in the external value of the rupee against a basket of global currency, but it doesn't factor inflation. If currency is nominal exchange rate falls less than domestic inflation rate, it has actually appreciated in real terms. The REIR is basically the need index adjusted for the inflation differentials between the home country and its trading partner. The REIR is in that sense is a true sense of whether a currency is undervalued or valued or fairly valued relative to that of other currencies after taking into consideration exchange rate and relative price.
Rear index in fact so to an all-time high of 108.06 in November 2024. From that peak, it has plunged by 9.8% to 97.47 in October 2025. The combination of nominal depreciation with unusually low CPI inflation is what has pushed the rare rear index to below 100, resulting in undervalued rupee. The current nominal depreciation and relatively low CPI inflation is sustained in the coming months could see a further decline in rupees need. Now, Ritik will go ahead with the current affairs.
Revision in labor codes, which are now being announced recently. The replaced 29 labor central labor laws. The 29 central labor laws has been replaced with four codes: wages, industrial relations, social security, OSH, making rules clearer and reducing regulatory overlap. This revision has expanded minimum wages, social security, and health and safety benefits for gig, platform, and unorganized workers for the first time. These workers involve delivery drivers working in major companies like Zomato, Swiggy, etc. The drivers for Ola, Uber, all those big corporates. This revision has also allowed fixed term employment, which has eased hiring and retrenchment and faster dispute resolution, which further supports business growth. So earlier, like there was no such concept of fixed term employment, and therefore the company would not be able to release all the employees even in case of like a contraction, in case of a contraction. So, due to this such kind of revision in the labor codes, this kind of benefit would allow manufacturers who are working in a cyclical industry to get more workers in terms of an expansion phase, and would be able to release workers in case of their contraction when the cycle goes out of favor. The other benefit is the benefit of labor law is it is expected to increase formalization, productivity, and also job creation. And we can see like the compliance requirements has also been reduced in the country. Compliance due to which it has fostered like ease of doing business. Additionally, it also reduced the regulatory costs, which was earlier a major hindrance for young companies that would take a significant toll on their pockets. The time required in order to for these regulations and the compliance to be like to be approved and for the submission and for the reviewing has also been drastically taken down. This has promoted more business growth as more companies are now, more individuals are now willing to start a company, start a business, and further contribute in the economic growth. The other and the major important factor is the financial services capacity expansion. We have seen recently like the cost of intermediation for the economy is starting to fall. What that basically means is like due to the excess capital provided by like strategic investors like mutual funds, private equity, there is ample amount of capital in the market, and the intermediaries, which are usually the banks and NBFCs, which provides these funds to which provides these funds to the users of capital, such as the manufacturers. So in this case, earlier, due to lack of capital, the users of like the manufacturers would have to take like the loan and everything from banks at a higher rate, as the banks used to get these capital, for example, 5%. They used to earn a margin, like they used to earn a spread of around 2% and give the money to the manufacturers at say 7%. So due to the ample amount of supply of capital in the market, due to such kind of big players, as well as the retained earnings of such corporates are also been growing, and they are usually using internal accruals as part of their major capexes. So in order to stay competitive, these banks and NBFCs have reduced their margins. So for example, in our earlier example, we said like 5% was the cost of the banks to source their funding, and they were taking a margin of say 2%. So now in order to stay competitive, they have reduced their margin, and now when eventually the manufacturing are getting the loan, for example, say 6%. So the return for which the banks were charging earlier was dropped by 1%. So this is better for an entire economy, as manufacturer, since it is getting like the funding at a low rate. It would it would encourage it to go for expansion, set up more factories, employ more workers, and then eventually increase our economic. So that is all from us.